Well, this week the Treasurer's budget update confirmed that the miners had dodged a bullet in their revolt against the resources super profits tax, with forecasts showing that the revenue that would have been raised from the tax as it was would have been double the government's original estimate. But that's not to say the miners have escaped the resources rent tax episode unscathed. I spoke to Ivor Ries, Research Director at EL&C Baillieu, who's been crunching the numbers. Well, Ivor, the Treasurer's update this week suggested that the new tax, the change tax, will raise about $7.5 billion less than the other tax was going to raise, not 1.5 as was originally stated. But the companies, the mining companies, are still going to pay a lot more tax than they used to pay, aren't they?
Yes, and very conveniently the budget forecasts exclude the year when the real slug hits, which is in 2015. So really that's the year where the real pain hits. And
What's
it's probably
the
going
pain?
to be...
How much of a slug is it?
Somewhere between $20 and $25 billion a year.
That comes off their bottom line?
Yes.
So why aren't the companies screaming still? I mean, they came out of their negotiations...
Because it's a lot less than they thought they were going to be slugged.
Which, it turns out, we find out from the Treasurer this week, was actually a lot more than he said they were going to be slugged.
Yes, that's right. He said today, I think, $24 billion instead of the $9 billion that they'd originally estimated. So he was just sort of fudged by about 15.
How do you reflect on the whole process that's occurred? You know, sort of RSPT, MRRT, one set of estimates, another set of estimates. What do you think? How do you look at it, and how do you think the investment world and business world reflects on it?
In a purely domestic point of view, the problem's been solved and the industry's got an outcome that they can live with. From a global investor point of view, it's really tainted Australia and it's increased the cost of capital to Australian companies quite significantly. So, and also some companies won't get finance. So,
how do you know that?
Well, just talking to investors. I've spent the last week before last running around the world talking to people who invest in these projects, and a lot of them are just too frightened to come to Australia now. So maybe we did need to slow down.
So just to go back to what impact it's going to have, the tax is going to have on those companies, what effect do you think it'll have, what percentage effect will it have on their net present values?
It's a pretty easy number. It's around about $100 billion worth of value that's been taken from the mining industry and spread across the rest of the economy. That's about the order of magnitude of it. But we won't see that until about 2015. That's when the tax really starts biting.
You've been saying recently that it's not just about tax. There's also an issue concerning commodity prices. Do you think that the Treasury, in making its estimates now and upgrading its commodity estimates, is actually picking the top of the market?
Not necessarily, because there's two things that are moving here. There's volumes and prices. It's very difficult predicting volumes and prices at the same time. And I think when they did their first estimate, they were assuming pretty low volume growth, and they're assuming some pretty low numbers. And what's happened is, of course, the volume growth has kept going. In round numbers, a 10% movement in price will change the tax number by roughly $8 billion. So our budget outcome has been linked to the commodity cycle. We're going to see wild gyrations in the federal budget surplus or deficit according to what commodity prices do.
And in particular iron ore and coal, isn't it?
Iron ore and coal, and also LNG. As well, so we've roped in all the LNG projects into it as well. So those three commodities are going to drive our budget, $20 billion either side of surplus or deficit.
Well, what do you think the outlook for the iron ore and coal prices are in the light of China's GDP, which also came out this week?
The short-term outlook's pretty good. Next 2 years, iron ore prices and coal prices should remain pretty robust. And volumes are definitely going up. China's economy was up 11% in the second quarter. So obviously the growth rate has slowed down a little bit, but nothing disastrous there.
Long term?
Long term, obviously iron ore prices are unsustainable. And as new production comes on, those prices will fall heavily.
So long-term outlook's not so good. What does that mean for smaller iron ore players, leaving aside BHP and Rio?
The smaller iron ore guys, unless they've got a contract with a Chinese mill today, may struggle to get up.
So just not get up at all?
Not get up at all, yeah. The reason is that, unless you can get a contract with a Chinese mill, you can't get financed. I mean, the cost of finance probably went up 5 percentage points as a result of the mining tax. So marginal projects are even more marginal than they were. And without a contract with a mill, you're as good as dead.
Thanks for joining us, Ivor.
Thanks, Alan.